Friends, thank you for being here today. What if I told you that the largest trading relationship in human history, worth over $900 billion annually, is being systematically dismantled right now in real time, and most Americans have no idea it's happening? What if the invisible flow of cheap energy, lumber, and raw materials that keeps your lights on and your home affordable is about to snap like a taut wire under too much tension? This is not speculation. This is mathematical reality unfolding across the longest undefended border in the world, and the consequences are already showing up in places most people aren't looking. Canada is America's largest trading partner, larger than China, larger than Mexico in terms of total dependency. They send 77% of their exports to us. For 3 decades, this has been the foundation of North American stability. But here's what the data is now screaming at us. Canadian exports to the United States just hit a multi-year low in late 2025, falling to a 67% share. The integration of the last 30 years is unwinding in months, not years. The flow of goods is actively dying before the official trade war has even fully escalated. And here's the number that should make your blood run cold: 2.2 trillion. That's the projected tax revenue the United States expects to raise over the next decade through these tariffs. But that tax isn't paid by foreign governments. It's paid by you at Home Depot, at the gas pump, in every lumber yard and construction site across this country. And it's going to cost the economy 0.5% of GDP in the process. The Eurasia Group, one of the most respected geopolitical risk firms on the planet, has designated the USMCA, the trade deal that was supposed to replace NAFTA and bring stability, as a zombie agreement in 2026. Technically alive, but functioning only to inflict pain through endless bilateral squeezes. This is not a trade dispute. This is a geopolitical divorce happening in slow motion, and the casualties are mounting. Why does any of this matter to you? Because Canada supplies 60% of US oil imports. They send us the timber that builds our homes. They provide critical minerals, aluminum, steel, the raw inputs that make modern American life possible. If Canada enters a depression, if provinces start banning American goods in retaliation, if the northern supply chain breaks, you will feel it immediately. Sudden shortages in building materials, energy price spikes across the northern United States, supply chain disruptions that make the pandemic look like a dress rehearsal. This is a structural fault line, not a policy disagreement. And to understand why it's inevitable, we need to go back to the moment the special relationship actually died. October 2025. The Ontario government ran an attack ad in the United States, not just any ad, a political spot quoting Ronald Reagan to criticize the administration's tariff policies. On the surface, it looked like normal political discourse, but in Washington, it was viewed as something else entirely: foreign interference in American politics. The reaction was instant and total. Negotiations ceased. Communication channels went dark. This wasn't a pause in diplomacy. It was the termination of a 30-year assumption that Canada and the United States were partners, allies, friends. From that moment forward, Canada became something else: a competitor, a rival, a target. And this leads us to the system's most crucial secret, which most analysts are still refusing to acknowledge. The United States has invoked Section 232 of trade law to declare Canadian wood products a threat to national security. Let that sink in for a moment. Canadian lumber, the material we've been importing for generations to build American homes, is now officially classified as a national security threat. This isn't economic policy. This is a legal designation that allows indefinite tariffs without congressional approval, making the trade war a permanent structural feature of American economic strategy. Think of it like this. Imagine you run a business, and for 30 years, you've had a supplier across the street, reliable, cheap, always there when you need them. Then one day, your government declares that supplier a security threat and slaps a permanent tax on everything they sell you. But here's the twist. You can't just find another supplier because this one provides 60% of a critical resource you can't do without. That's the trap Canada is in. That's the trap we're in. Now, the mechanism being used here is what I call the tariff pincer, a double vise that's squeezing Canadian industry into either submission or extinction. Here's how it works. To avoid tariffs, Canadian goods must be USMCA compliant. Sounds reasonable, right? Except the United States keeps changing the definition of compliant for sectors it wants to control: steel, aluminum, automobiles. The rules shift just enough to make compliance impossible. So Canadian factories face a choice: stay in Canada and pay indefinite tariffs that make you uncompetitive, or move your entire operation south of the border to survive. This isn't trade policy. This is economic annexation, the deliberate deindustrialization of our northern neighbor to transfer productive capacity to American soil. And it's working. Investment is already flowing south. Jobs are already moving. The Canadian economy is hollowing out. But here's what almost no one is talking about, and this is where it gets dangerous for us. Canada is quietly pivoting. Exports to China are up 18%. Exports to the UK are up 91%. They're selling their strategic resources, the energy, the minerals, the raw materials we depend on, to other buyers. If we keep pushing them away, they will find new customers. And those customers will be our geopolitical rivals. We are creating a competitor on our own border, a resource-rich nation of 40 million people with every incentive to align economically with China, with Europe, with anyone who isn't actively trying to destroy their economy. The long-term consequences of this are almost impossible to overstate. But the immediate consequences, those are showing up right now in ways that should terrify anyone paying attention. July 1st, 2026, mark that date. That's when the official USMCA joint review takes place. This was supposed to be a formality, a rubber stamp renewal of the trade agreement that keeps North American commerce flowing. Instead, it has become a high-stakes negotiation where the United States will threaten to terminate the entire deal unless Canada makes massive concessions on dairy, digital taxation, and most critically, their alignment with China. This is the trigger event, the moment when the zombie agreement either gets revived or receives its final burial, and all the signs point to burial. Let me show you the canaries dying in the coal mine right now, because these aren't abstract economic indicators. These are real, tangible breakdowns happening in real time. Canary number one, the liquor purge. Canadian provinces, Ontario, Alberta, British Columbia, have removed all American alcohol from their shelves in direct retaliation. Walk into a liquor store in Toronto right now, and you won't find a single bottle of Jack Daniels, not one case of Budweiser. This is a visible consumer-facing trade war happening at this very moment. It's not a threat. It's not a negotiating tactic. It's actual economic warfare playing out in grocery aisles. Canary number two, the lumber crisis. The U.S. Commerce Department just concluded that Canadian lumber imports are, and I quote, weakening our economy, and impose new duties accordingly. Now, pay attention to the timing here. We're entering spring construction season. Housing starts traditionally spike in March and April. Builders need plywood, framing lumber, structural materials, and the primary source for those materials just became 20-30% more expensive overnight. What does this mean for you? If you're planning to build, renovate, or even do basic home repairs this year, expect sticker shock. Plywood prices are going to spike. 2x4s are going to spike. And unlike previous supply chain disruptions, this one isn't temporary. This is policy. This is permanent until someone blinks. And right now, nobody's blinking. Canary number 3, and this one reveals the deeper rot, the productivity gap. Canadian labor productivity has now fallen 30% below American levels. Canadian workers are producing $74 per hour of economic output compared to $97 per hour in the United States. That's not a small gap, that's a chasm. And here's why this matters. Canada cannot compete with the United States on productivity, on scale, or on market access. Their only competitive advantage has been a cheaper currency and tariff-free access to American consumers. We just took away the tariff-free access. So what happens next is inevitable. The Canadian dollar crashes further, making their assets cheap for American buyers, but making their imports to us prohibitively expensive. You see the trap now? The vice closing from both directions? For Canada, if they retaliate harder, the United States can crush 77% of their export market with a single executive order. They are existentially dependent on access to our economy, and that access is now being used as a weapon. But for the United States, if we crush them completely, we lose our secure supply of energy. 60% of U.S. oil imports come from Canada, not from Saudi Arabia, not from Venezuela, from Canada. We lose access to critical minerals needed for batteries, for defense systems, for advanced manufacturing. We lose the integrated supply chains that make American auto manufacturing competitive. This is mutual assured economic destruction. But here's the asymmetry that everyone is missing. The United States consumer pays the immediate price in inflation, while the strategic consequences play out over years. Let me paint the picture of what this looks like on the ground because the encirclement is already complete. You're a Canadian manufacturer of auto parts. You've been selling to Ford and GM for 20 years. Suddenly, your products need to meet new USMCA compliance standards that didn't exist 6 months ago. You invest millions retooling your factory to meet those standards. Then the standards change again. You realize the game is rigged. You can never be compliant enough because compliance isn't the goal. Relocation is the goal. So you face the choice. Move your factory to Michigan and fire your Canadian workers, or watch your contracts disappear as American competitors who don't face these barriers undercut your prices. Either way, Canadian industrial capacity bleeds south. Now you're an American consumer walking into Lowe's to buy materials for a deck. The pressure-treated lumber you bought last year for $8 per board is now $11. The contractor you hired just added a 15% surcharge for materials volatility. Your neighbor mentions his heating oil prices jumped 20% because the local distributor's Canadian supply contracts are in chaos. These aren't hypotheticals. These are the early tremors of a much larger earthquake, and you're a Canadian homeowner watching your currency lose value every week. The Canadian dollar is in free fall because international investors see exactly what's happening. A mid-sized economy being systematically squeezed by its largest trading partner with no viable alternatives. Your savings, denominated in CAD, are evaporating in real terms. Your government is paralyzed between retaliation that guarantees economic catastrophe and capitulation that guarantees political humiliation. The liquidity tide is going out, and we're about to find out who's been swimming naked. But here's where this gets truly dangerous, and why I keep coming back to this phrase: there is no escape from the encirclement. The traditional playbook says diversify your trade relationships, find new markets, reduce dependency. Canada is trying. Those exports to China and the UK aren't accidents. They're desperate attempts to build alternative pipelines for their resources. But commodities markets don't work on political timelines. You can't just flip a switch and redirect 77% of your export economy to new buyers. The infrastructure isn't there. The contracts aren't there. The logistics chains aren't there. So what actually happens? Canada sells their oil and lumber and minerals to whoever will buy them at whatever price they can get, which means those resources flow to our competitors at a discount while we pay premium prices for substitutes that are lower quality and less reliable. We are engineering our own strategic disadvantage in real time and calling it America First. The zombie USMCA shambles forward, technically alive, but rotting from the inside. Section 232 national security designations proliferate, turning every trade relationship into a potential battleground. The compliance trap tightens, making it impossible for Canadian businesses to operate profitably without abandoning their home country. And through it all, the Eurasia Group's designation hangs over this entire situation like a prophecy. Canada is the most at risk nation in 2026, not because of internal weakness, not because of bad governance, but because of collateral damage from American economic nationalism that treats allies and adversaries with equal contempt. So let's bring all of this into focus, because we are now facing a convergence. Three distinct forces hitting simultaneously, and the collision point is closer than most people realize. Force number one, the zombie USMCA. This is permanent uncertainty embedded into the architecture of North American trade. Every business decision, every investment, every supply contract now carries political risk that didn't exist 5 years ago. Companies cannot plan. They cannot invest long term. They exist in a state of perpetual limbo, waiting to see if the rules will change again tomorrow. This isn't policy. It's paralysis disguised as strength. Force number two, the productivity collapse. Canada is falling further behind economically with every passing quarter. That 30% productivity gap isn't closing, it's widening. Their labor force is producing less value per hour while their costs remain anchored to a global economy that doesn't care about their domestic challenges. They're trapped in a downward spiral where lower productivity leads to lower investment, which leads to even lower productivity. This is the death spiral of developed economies, and Canada is in it right now. Force number three, the retaliation spiral. Provincial governments banning American goods, trade officials walking out of negotiations, diplomatic channels freezing. Every action produces a reaction, and every reaction produces escalation. There is no off-ramp visible in this dynamic because both sides have now made this about national pride and sovereignty rather than economics. And once you frame trade policy as existential identity, compromise becomes political suicide. These three forces, the zombie agreement, the productivity collapse, the retaliation spiral, are not separate problems. They are reinforcing feedback loops, amplifying each other's destructive potential. And they are converging on that July 1st, 2026 review date like a financial asteroid. But here's where I need to shift our focus, because the real danger isn't just in the markets or the trade data. The real danger is in your mind, in how you're processing this information right now. There's a concept in psychology called normalcy bias. It's the human brain's hardwired tendency to believe that tomorrow will look fundamentally like yesterday, that the patterns which have held for your entire lifetime will continue to hold indefinitely. It's the reason people don't evacuate before hurricanes, even when they're told to. It's the reason investors hold stocks all the way down in crashes, certain that it always comes back. And it's the reason most Americans cannot process what's happening with Canada right now. You've spent your entire life in a world where Canadian trade was invisible, automatic, and stable. The lumber showed up, the oil flowed, the supply chains hummed along in the background. Your brain has filed this under permanent features of reality alongside gravity and sunrise. So when I tell you that relationship is ending, your normalcy bias immediately generates rationalizations. They'll work it out. They always do. This is just negotiating theater. Canada needs us too much to let this fall apart. But that's your psychology lying to you, because the data is screaming the opposite. The relationship has already fallen apart. The trade flows are already collapsing. The retaliation is already happening. You're not watching the beginning of a crisis. You're watching the middle of one that started months ago while you were paying attention to other headlines. And this connects to something even more insidious, the friend shoring fallacy. For the last 3 years, we've been told that the solution to supply chain vulnerability is friendshoring, moving production from geopolitical rivals like China to trusted allies like Canada and Mexico. Secure our supply chains by buying from friends instead of adversaries. It sounded logical. It sounded safe. But here's the reality that no one wanted to say out loud. There are no friends in an America First economy. There are only leverage points and vassals. The supply chain isn't coming home through cooperation. It's being extracted through coercion. And the countries we called allies are discovering that friendship means nothing when economic nationalism meets political ambition. Canada was the test case. They did everything right according to the old rules. They integrated their economy with ours. They aligned their regulations with ours. They built their entire industrial base around access to our markets. And now they're learning that interdependence isn't mutual protection. It's mutual vulnerability. And in a world where vulnerability equals weakness, they're being systematically exploited. This is the psychological pivot you need to internalize. The interconnected global system that defined your economic reality for 30 years is not reforming. It is not adapting. It is decomposing. And the decomposition creates opportunities and catastrophes in equal measure, depending on which side of the trade you're positioned. So now we arrive at the binary choice, the decision that separates preparation from denial. Do you own assets or do you own claims on assets? Do you hold positions in companies dependent on cross-border trade and integrated supply chains, the REITs that own warehouses along the Canadian border, the manufacturing stocks built on just-in-time delivery from Ontario, the retailers sourcing materials from Vancouver? Those are claims on a system that is actively breaking. Paper wealth built on the assumption of continued cooperation. Or do you hold positions in domestic commodities, in American energy producers, in companies that benefit from shortages and supply constraints? Those are actual assets in a world of scarcity and nationalism. Here's the specific action. Watch two indicators like your financial life depends on it, because it might. First, lumber futures. If lumber prices spike above recent highs and stay there through spring construction season, you're watching the Canada supply shock translate into real inflation. That's your signal that the northern supply chain is actually broken, not just bent. And once lumber goes, everything else built on cross-border materials follows: plywood, paper products, prefab components. Second, the Canadian dollar against the US dollar, the CAD.USD pair. The Canadian dollar has been weakening steadily, but there are key technical support levels that, if broken, signal a currency collapse rather than a currency correction. If KD breaks decisively below 70 cents US and stays there, you're watching capital flight in real time. You're watching international investors conclude that Canada's economy is entering a multi-year depression. And that's when the fire sale begins. Canadian assets, Canadian companies, Canadian real estate, all available at basement prices for American buyers with strong dollars. This is not investment advice in the traditional sense. This is pattern recognition. This is understanding that when a $900 billion trading relationship unwinds, there are profound dislocations in asset prices, in currency values, in commodity flows. And those dislocations create asymmetric opportunities for people who saw it coming and positioned accordingly. But most people won't position accordingly because most people are still trapped in normalcy bias, still believing that the post-NAFTA world is the permanent world, still certain that cooler heads will prevail and trade will normalize. Human beings are hardwired to believe tomorrow will look like yesterday, but the data, the actual mathematical reality, tells a different story. Canadian exports to the United States at multi-year lows. The USMCA officially designated a zombie agreement. Section 232 national security designations proliferating. Provincial governments purging American products from shelves. A July 2026 review date that looks less like a renewal and more like a funeral. This is not a trade dispute that will be resolved in a few quarters. This is a structural realignment of North American economics that will define the next decade. The special relationship is over. The integrated supply chain is breaking. The northern border is becoming an economic wall. And the window for preparation is closing in real time. You can choose to believe that systems which have existed for your entire adult life are permanent and unchangeable. That's comfortable. That's easy. That requires no action and no difficult decisions. Or you can look at what the actual data is telling you, that the foundation is cracking, that the scaffolding is buckling, that the architecture of North American trade is undergoing violent restructuring, whether we're ready for it or not. History favors the prepared. History rewards the people who saw the fault lines before they became earthquakes. History punishes those who confuse stability with permanence. The Canada crisis isn't coming, it's here. The trade divorce isn't hypothetical. It's documented in export data and currency charts and empty shelves in Ontario liquor stores. The only question remaining is whether you're going to acknowledge the mathematical reality in front of you or whether you're going to keep believing that tomorrow will look like yesterday until the day it doesn't. The northern supply chain is snapping. The question is whether you're positioned for what comes after the snap, or whether you're still holding claims on a system that's already gone. The choice, friends, is yours. But the clock is ticking and the convergence is accelerating. July 2026 is not some distant deadline. It's 6 months away. And 6 months in a collapsing trade relationship is barely enough time to reposition, let alone to remain in denial. Watch the lumber, watch the currency, watch the signs that everyone else is ignoring. Because when the mathematical endgame finally arrives, there won't be time to adjust. There will only be time to survive.